By the end of 2025, one of the most important trading rails in crypto will not look like a typical decentralized exchange. It will look like a full-stack market system that matches orders, manages leverage, and settles every action in public. And if you miss that shift, you will keep trading narratives while other people accumulate infrastructure. That system is Hyperliquid. Most people hear that name and think it is just another place to trade. That is their first mistake. Here's the anchor you can actually measure. Public dashboards show Hyperliquid processing very large perpetual trading volume with large open interest. If those words mean nothing, here is what they mean in plain language. A lot of capital is already using it to take leveraged positions that must be managed in real time. Sounds like a niche trader playground. Except it is turning into something much more strategic. Hold that thought. Because while most of the market is still watching price, you are here studying the rails. And if you understand the rails, you stop getting distracted by things like Bittenser price prediction and decentralized AI headlines that dominate feeds but rarely explain the plumbing. Now let us start simple. A normal decentralized exchange is like a swap booth. You show up, you trade against a pool, you leave. Hyperliquid behaves more like a professional exchange. You place limit orders. You see an order book. You can trade perpetuals with leverage. You can get liquidated if you are wrong. Most people stop here and say, it is just a better trading app. That is their second mistake. Because the real question is not what it feels like. The real question is what it is built on. Now here's where it shifts. Hyperliquid does not run as an app on someone else's congested chain. It runs on its own Layer 1 network. That means the trading system and the chain underneath are designed as one machine. And when the machine is one piece, it can behave differently under stress. That changes everything. Now zoom out. In 2025, the market is maturing. Exchange-traded fund headlines come and go. Rate cuts get priced, then repriced. But the deeper shift is simpler. Capital is rotating toward venues that work when the room is on fire. Not just chains that look good in a bull market. Not just tokens with loud narratives. Systems that keep executing when volatility hits. Because when volatility hits, execution is the product. And if execution is the product, the chain underneath is not a marketing detail. It is the business. Here's the problem most people underestimate. On most chains, high-speed trading becomes a tug of war. If you push for transparency, you get latency, failed transactions, and chaos during spikes. If you push for speed, you often end up with a hidden matching engine and trust assumptions. Retail tolerates that trade-off. Serious capital does not. They want speed, but they also want auditability. They want performance, but they also want predictable rules. They want to know that when the market snaps, the system does not quietly change the rules. Hyperliquid is trying to sit in that uncomfortable middle. Fast order book trading, with the state recorded on chain. If that sounds like a small detail, you are missing the consequence. Because the venues that survive stress become the venues institutions integrate. And the venues institutions integrate become the venues that shape the next cycle. Now the origin story in plain language. Hyperliquid did not start as a token-first project. It started as a product-first trading venue. Get execution right. Get reliability right. Then let network effects do the marketing. Most projects reverse that order. They launch a token, chase listings, and hope a product appears later. Hyperliquid built the venue first. That is why it compounded attention differently. Hold that thought. Because token launches can create noise, but fee engines create gravity. Now we get to the core design. Think of Hyperliquid as two layers built on one backbone. The first layer is the high-speed trading system that runs the order books and perpetual markets. Every order, cancel, trade, and liquidation updates the public state. The second layer is the smart contract side, designed so builders can create applications close to the liquidity. Here's why that matters. Most chains have smart contracts first and liquidity second. Hyperliquid is liquidity first and programmable apps second. That flips the incentive structure, and incentives decide who stays when the market turns. Now pause. Most people hear smart contracts and think, great, another chain. That is not the edge. The edge is that the venue and the chain are one economic machine. If the chain is the exchange is the killer app. If the exchange is the killer app, liquidity becomes native. If liquidity becomes native, builders build around it. And if builders build around it, you get a flywheel. Most people do not see flywheels until it is too late. Now let us ground it in real use. The first use case is obvious. Perpetual trading at scale with an order book. But the second use case is the one the market underprices. A programmable trading venue where liquidity, margin, and settlement are building blocks. Picture a risk desk dashboard. Positions updating in real time. Liquidation rules enforcing discipline automatically. Margin moving without waiting for a congested mempool. In a stress event, that is not a feature. That is survival. Now bring it back to institutions. Institutions do not just want to trade. They want to integrate. They want stable interfaces and stable rules. They want a venue that becomes part of a workflow, not a website they click. This is where a purpose-built Layer 1 can matter. Now token mechanics, without fantasy. Hyperliquid has a native token called HYPE. Do not get hypnotized by supply charts. The only token question that matters is value capture. If the venue generates meaningful fees, where do those fees go? If the system links usage to demand, the token becomes a proxy for the rail itself. Sounds bullish, right? Except sustainability is the real test. Is the volume real? Is it sticky? Does it stay during drawdowns? Or does it vanish when incentives fade? If you want one institutional lens, it is this. Watch what stays when the market turns against the crowd. Now, adoption signals, grounded in what you can observe. Public metrics show strong trading activity, meaningful open interest, and significant fee generation. Those are not vibes. Those are indicators that traders are treating it as a primary venue, not a side experiment. If those indicators persist, Hyperliquid stops being an altcoin story. It becomes a market structure story. And market structure stories do not announce themselves early. They creep, then they snap. Now the uncomfortable part. Risks and criticisms. First, concentration risk. High-performance systems can depend on tight coordination, even when the state is public. If key decisions cluster, confidence can break fast in a crisis. Second, stress risk. Perpetual markets are where systems get tested violently. Flash moves, cascading liquidations, edge cases around price feeds. If a venue fails once during a major event, trust can evaporate overnight. Third, regulatory and venue risk. A high-volume derivatives venue attracts attention. Decentralized architecture changes some assumptions, but it does not erase legal reality. Fourth, narrative risk. If buybacks and token support become the headline, the market can misprice the cycle. When the cycle cools, expectations can punish the token, even if the product remains strong. Hold that thought, because this is where the future outlook becomes decisive. If Hyperliquid keeps compounding real usage, it becomes a gravity well. Liquidity attracts builders. Builders attract users. Users attract more liquidity. And suddenly the chain is not the story. The venue is the story. Most people will not notice until the rails are already owned. Now the strategic takeaway. Hyperliquid is not a decentralized exchange you trade on. It is a Layer 1 you trade through. That difference sounds semantic until you feel the consequences. A normal decentralized exchange competes on fees and liquidity. A trading Layer 1 competes on speed, determinism, integration, and trust under stress. If Hyperliquid keeps holding volume when volatility spikes, the market will re-rate it as infrastructure. And infrastructure does not need hype. Infrastructure just needs usage. So here's what you do. You do not chase narratives. You track rails. You watch volume quality. You watch open interest behavior. You watch whether liquidity stays during drawdowns. You watch fee generation. And you stop letting the market distract you with the wrong conversations. Yes, people will keep asking for bit-and-sword price prediction. Yes, decentralized AI will keep trending. But you are not most people. You are studying the infrastructure that moves risk and capital in real time. That is the edge. If you value deep research like this, subscribe to Crypto Wayfarer. Because we are not chasing hype. We are decoding infrastructure. Stay sharp, stay strategic, and keep wayfaring.